Good morning and welcome to this morning's webinar. My name is Jim Doyle and I'm joined by my colleague Michael Coburn, and we will jointly be presenting today's webinar. So our topic is how to protect and grow your pension in these difficult times. And of course, the more I think about this topic, it's really about what we do to protect and grow your pension and your clients' pensions in these volatile times. So it's about the things that we do, it's to protect, and it's about the things that the pension companies themselves do to protect and grow your pensions. Okay. So before we get stuck in, here are some of the webinar topics we've covered so far in this series, specifically for accountants. In July, we had a webinar with Jim Power, the economist. We had a webinar in August there, which Michael Coburn delivered. This one is in September. We do plan webinar number 4 in early December. We're very conscious that right now you're entering a very busy income tax season. So we plan to continue the series in early December. Here's the agenda for today. It's absolute maximum 45 minutes. That means 11:45 will be finished and gone. And so a little bit of an overview. Michael is going to give a financial markets and pension funds, how they've behaved, how they're performing. Secondly, information about pension fund growth, how important it is, the things we can do to help it to perform better. Some information on some good and poor performers this year and over the last number of years. Different strategies for those approaching retirement. That's been requested by a number of accountants from us, so we want to address that here today as well. Bit of information about our thoughts and what's really going on worldwide right now in 2020. And we have an offer for accountants, which we'll go through towards the end of this webinar. There will be some question and answer section. If we don't get to cover any questions, we will address those after the webinar directly with the people who asked those questions, as we have done in previous webinars. We will be issuing you with a certificate of attendance later on. So before we get stuck in again, just to let you know, we founded this company in 2005. It's led by Michael and myself. A little bit about myself. I am also an accountant. I did own an accountancy practice called RDA Accountants, which I set up with a business partner in 2002. I was a 50% shareholder in that business. I sold my 50% shareholding 2 years ago in 2018. I've exited that business, but throughout that time, I was managing the Guardian Wealth side of our business. But just to let you know, I do identify with your own position, your own role, the job that you do advising clients. And of course, these days, I am fully focused on pension and financial planning for business owners. That's what I'm very much devoted to. And I have to be devoted to it because we have just over 100 million of funds that we advise our clients about. So, you know, that's we have to take that very seriously. We have to have systems and processes in place to be able to make sure we do that job properly. You can see the geographic area we covered there, and we have offices in Dublin and in Wexford. So over to Michael to tell us, get into some detail about pensions.
Thank you very much, Jim. Good morning, everybody. It's great to see such good numbers here on the webinar again this morning, this being the 3rd of our summer series of webinars, although looking out the window here this morning, there's not a whole lot of summer left, unfortunately. So as Jim said, I'll take the middle portion of this webinar. Should take no more than about 15 minutes. There's a couple of topics I want to touch on. And really what I want to do, I want to look at pension funds and just give an overview of, generally speaking, what do pension funds invest in and why do they invest in anything at all? And following on from that, I want to look at the performance of the financial markets, of the stock market over the last 10, 20, 30 years, just to see how it has behaved or how it has misbehaved, as the case may be, and what the implications are for that in terms of pension investors. We also want to extrapolate from that and start looking at pension fund managers and how successful or not they may or may not be when it comes to managing client monies, bearing in mind that they are invested directly in stock markets and other assets. And just looking at that, I want to look really, I suppose, at the whole topic of how what can seem maybe relatively small percentage gains and differences in pension fund managers, what can that can actually mean to your pension fund over a period of time, and then look at maybe the implications of that in terms of strategy for older pension clients or those who are approaching retirement. So really, any pension fund, it tracks and it invests in financial markets. And what does that mean? Well, it means that pension funds can invest in cash, they can invest in bonds, properties, equities, commodities, metals, gold, etc. So pretty much anything you can think of investing in, that's what pension funds and pension fund managers can actually invest in. But why do they, and it might seem like a simple question, but why do they invest in anything at all? Well, if you take into account what your money actually needs to do to get the pension job done for you long term, well, number one, your money has to beat inflation. And inflation at the moment is almost a non-existent entity. European Central Bank target is to have an inflation rate of about no more than about 2% per annum. But if we take it there, as you can see on the screen, that look, at the very least, we're trying to beat on average about 1% inflation. There's also fees on your pension as well. So we need to beat whatever the annual management fees are on that pension. And again, they're going to vary across pension companies and funds. But if we take 1% again as a benchmark. So then on top of the 1 plus the 1, which is 2, we also need to make money. So we'd like to make probably, wouldn't we all like to make 20 or 30% each year? But at least if we could make kind of 3% each year, we'd be getting somewhere. So you add all that up, and really your pension needs to make about 5% each year. And I think that's the kind of the benchmark and the standard that we and you should be aiming for. So what makes 5% per annum on average over the long term? Well, it's definitely not cash. You would have seen yourselves probably quite recently, if you're keeping an eye on these things, that there are actually negative deposit rates on offer from some of the banks. I think it was Bank of Ireland announced a negative deposit rate for pension investors of minus 0.65% per annum. So essentially they are charging you to hold your cash. And that also has big implications for anybody who has a self-administered pension scheme, which we would see a lot of. People set up these self-administered pension schemes to have more control over their I suppose what they want their money invested in. And a lot of the time it just ends up sitting in cash just down to pure inertia. And that is losing money over a period of time, which is a big problem. So what I have on the screen there is just a very basic sense of, okay, what can my pension invest in? We've spoken about cash. We have spoken about, we're going to speak about fixed interest. So fixed interest are government and corporate bonds. We have property, we have alternative investments, which are the likes of commodities, gold, etc., hedge funds, and then right up the top right of the screen there, we have shares, which is the stock market. So we take it for a second that cash offers no return. If we take it for a second that fixed interest, which are government bonds at the moment, are offering actually in a lot of cases a negative return. So if you wanted to hold a bond with the German government at the moment, a 10-year government bond, they would actually charge you for the privilege of holding your money. So whilst cash and fixed interest, the risk inherent in losing money with those types of assets is very low, if not non-existent. The potential return has always been low, and at the moment the potential return is non-existent. So by default, whether one likes it or not, if you want your pension to get the job done, to get this 5%, you were almost forced to start looking at property, stocks and shares, alternative investments, etc. So that's the landscape in which you're placing yourself. So what I want to look at here is the whole concept. Without, we can't look at each of these asset classes in turn, it would take too long. But predominantly most pension funds, the biggest exposure that they would have is into the stock market. There's a great quote here from Warren Buffett. Most of you will have heard of this guy. I think he's in his late 80s, if not pushing 90 at this stage. Arguably the most successful investor of all time. So you would think, God, this guy's a lot of tricks up his sleeve. But he does give very sage advice. He's not known as the Sage of Omaha for nothing. And one of his best quotes, and he has a lot of them, is the stock market is a device for transferring money from the impatient to the patient. So trying to time the stock market and trying to time the purchase of shares and when is the right time to buy and get in and out and out and in and consistently get that right over 20, 30, 40 years. For us mere mortals, it's pretty much impossible. And for this guy, he would almost say it's impossible as well. And to illustrate that point, because this really is the core of a lot of understanding what happens to pension funds. This is a very busy slide, admittedly. So this is looking at the US stock market. So down in the bottom left-hand side of the screen here is 1982. And then we kind of bring it all pretty much up to present day, and we're looking at the recent coronavirus. So what this represents is the bones of about a 10,000 euro investment in the US stock market back in 1982, which if left there, riding out all the peaks and the troughs and the good days and the bad days, the highs and the lows, that 10,000 euro would be worth the bones of about 200,000 euro at this point in time. So that's, in broad strokes, that's the kind of journey that any pension investor has to almost accept in order to get the job done for themselves and their family long term. So you can see that it does work, but it ain't pretty over the intervening years. I'm just going to take the example here, just kind of right of center. We have, I suppose, aside from the crash that happened in the last couple of months due to coronavirus, a lot of people would remember and have experience of 2008, 9, and 10, which was the last big financial crash on stock markets. So this was the global financial crisis. And you can see here, stock markets down the bones of 50, 60% in a relatively short space of time over the bones of about 18 months. And I do remember, because I was an advisor and advising people on pensions at that point in time, and some of the headlines were it will take 20, 30 years for the stock market to recover. This is this crash is different. This is really the end of it, and plenty of other headlines to boot. But really, if you look at it, for people who held their nerve and were in a position to hold their nerve at that point in time, which we will come to a little bit later, give it about the bones about 2 years, 2.5 years, and the stock market had recovered from its lows. So in reality, the stock market is a track of capitalism, and we all work it's not foolproof, but we all work in a capitalist society. So if you believe in capitalism and you believe that companies and countries and people can increase their wealth over a period of time, that really is what the stock market is all about. It's just a gauge of capitalism, and a bit like people, it doesn't go according to plan, and there are lots of highs and lows and adventures along the way. Just to put into a bit of context then too, we have the coronavirus crash happened back around end of February into March, April of this year. Again, stock market's down by about 30%, if not a little bit more, in the space of about a month, quickest crash of all time. But they did recover again, and are currently back to the point that they were at before the crash actually happened. Now, who's to say it's not going to happen again? We'll form some views on that in a little bit. Which actually, this slide is quicker than I had thought. People are kind of constantly asking us and asking me and asking Jim, what does the next 12 months hold? If I knew that, I would be Warren Buffett and I'd be giving out that sage advice. Even this guy has no idea what the next 6 to 12 months actually holds. I think it's fair to say, what we can say is there's a lot of trouble, unresolved trouble ahead, all of which will impact financial markets in some way, shape or form. And I have a couple of pictures on the slide there, and you can kind of take your pick. Right in the middle of the screen is the coronavirus. So that is very much with us. Whether we get a vaccine or we don't get a vaccine, even if we got a vaccine at some point next year, which is the hope and the prediction, how effective will it be? What will the uptake be on it? Will it be a rush vaccine? People mightn't be comfortable to take it. There's not going to be enough to get to everybody. So we'll just have to wait and see how that rolls out. We also have down kind of just below that, we have Brexit. Again, it hasn't gone away. It's in a bit of a lull at the moment, but that's going to be front and centre for the UK and Europe, and especially Ireland towards the end of the year, and that continues to be an unholy mess as well. We also have US elections. Anybody who follows US politics, it just gets stranger and weirder by the day, and God only knows how that's going to go. And even if Mr. Trump gets voted out of office, there is a big concern about his appetite to actually pack his bags and leave the building. And that undoubtedly, one way or another, is going to have an impact on financial markets. We also have down the bottom left here, a very sad looking individual in an empty office. So what's the future of commercial property, retail, industrial, etc., with the new working at home genie well and truly out of the bottle and not going in anytime soon. And it has been a cultural shift, I think, to a lot of businesses. What does that mean for commercial property into the future? There's a big question mark over it. So if there are a lot of headwinds to come, and if you were to look at this, financial markets, to say, well, we had the crash, we had the recovery, and you were thinking, well, if we got to the end of this year with no net fall in stock markets in the middle of all of these issues, I would find that very hard to believe. So I think there is an awful lot of more bumps in the road and trouble ahead, certainly in the short term. And I think that's the Oliver Gogarty up here. If that weren't bad enough, all the pubs are closed too, or most of the pubs are closed. So we can't even drown our sorrows, unfortunately. So the next 6 to 12 months, very uncertain, and more reasons to be pessimistic than optimistic, I think. This actually neatly brings us on to our next slide, which is pension fund strategy for those nearing retirement. So, look, if you're in your late 30s, early 40s, arguably mid to late 40s, these, I suppose, events on stock markets really don't feel particularly real from a pension point of view, because it's accessing your pension is so long in the future. It's not a huge concern. It's not something that keeps you awake at night. But as you get into your 50s, mid 50s, late 50s, heading towards the point at which pension, as one client said to me once, the pension money as every year passes, it starts to feel an awful lot more real. Then you're not as blasé, I suppose, about what's going on in the stock market, because it can have a very real impact on your life and on your decisions. And it actually, there is a subtlety in terms of how you should and how we would structure a client's pension fund for those who are within a couple of years of retirement. And I'm just going to talk you down through that for a second, if that's okay. So we have Paul here. I think Paul was in our last webinar. Again, looking quite pleased with himself, as well he might. He has a €900,000 pension fund, and he's looking to retire next year, as far as he can tell. So the first thing we need to look at is to understand for Paul, when he goes to access that pension fund in a year's time, what exactly is going to happen and how does that look? And understanding that and how that looks, would that make a difference in terms of the investment strategy he might have on his pension at this point in time? So I'm going to talk you down through this table here. So Paul has a €908,000 pension fund. He's going to be, as most of you will be aware, he's going to be entitled to a quarter of it as a tax-free lump sum, which is $227,000. Of that $227,000, he's going to be allowed $200,000 of that tax-free, leaving about $27,000 of it to be taxed at the 20% tax band, which is going to cost him about $5,000. So his lump sum net is going to be about $221,000. So we know that we have this lump sum coming next year. And the balance of his pension fund, which is about $681,000, that goes into, as most of you will be aware, and we might actually do a webinar on this at some point in time as well. But after you get your lump sum, from 99% of people, the balance of the pension fund goes into what's called an ARF an approved retirement fund, which is a bit like a rollover pension fund, stays invested from then on in, and that's the fund that you are drawing income from in retirement. And the rules around approved retirement fund really are that you can take as much as you want, but you are obliged to take a minimum of 4% each year. So if we're looking at his approved retirement fund of 681,000, well, we know that he's going to over a period of 5 years, he's going to take about 136,000 out of that, and the rest of it, the other 357,000, really he's not going to need for years 5 until 20, 25, and 30. So how does knowing that structure and what's going to happen, how does that impact the investment decisions, and what's the right way of investing this, or Paul having his pension fund invested in preparation for all of this? Well, it's back to the lump sum, because if we know that the lump sum coming next year is going to be about 225,000 gross, well, then it kind of makes sense, arguably, maybe to put the 227,000 in his pension fund actually into a cash fund. We know it's not going to grow any. We know, with fees, it might even lose 0.2 or 0.5%. Who's to say? But that's not the issue. The issue is that we know that money is coming out to Paul in 12 months' time. So we need to put that into something quite boring, secure, safe. It's very predictable, and Paul has sight on that, and he knows exactly what's going to happen and where that money is going to come from. So he doesn't need to worry about that. And then if we move on to the 136,000, which is the 5 years of ARF income that he's obliged to take, and we know that that's going to happen because they are the rules of approved retirement funds as laid down by revenue. Well, if we know that this money is going to come out over 5 years, and that's income for him, and we know that that's all he's going to need because he has such a large amount of cash in the bank as a result of the lump sum, well, then we can put that 136,000 in a kind of a medium-ish risk fund. But then we know that the balance of the fund, everything left, which is the other 60-odd%, we know that that's not needed for at least 5 years, and some of that money is not needed for 15, 20, and 25 years. So we can afford to take more risk with that because we appreciate that that portion of it will fluctuate in value because we've looked at financial markets and how they behave, but we do know that that's the way to get more growth on that money in the long term. So it's just a sensible approach in terms of how to structure or how certainly we would structure our clients' pensions at that point in time. And I would encourage you to do it for yourselves if you're at that point, and certainly have conversations with your clients as well. So another 1 or 2 slides here, but really what I want to look at is, okay, well, we've looked at financial markets, we've looked at maybe a little bit of investment strategy when it comes to pensions. Well, the question then arises is, is there a big difference between pension fund companies and pension fund managers? Because if they're all invested in pretty much the same underlying assets, surely they should all be getting pretty much the same return. So if you take the likes of, most of you will be aware of the pension companies involved, you have your Irish Life, Savivas, Bank of Ireland, Life, Zurich, Friends First, etc., etc. And at this point in time, it's a fairly limited market, and there are only about 6 or 7 of them out there with mergers and acquisitions and consolidation, etc. But believe it or not, even though they're all invested in the same underlying assets, the performance of the funds that they run, when you're even comparing like with like, there can be huge differences in the performance of of those companies. And really, our job is to keep an eye on that and to look at different companies and say, well, who's producing the goods, who was the track record, who's getting it wrong, why are they getting it wrong, do they even know why they're getting it wrong, what are they going to do to improve it? So there's a kind of a constant monitoring of all of these guys just to make sure that they are doing the best for pension investors. So what I have here is another table, and as accountants, I know you are not afraid of tables and percentages and charts. Just to illustrate this point, and it's quite a staggering point, really. So what I've taken here is an active managed fund. So really what that is it's a managed fund which typically would be about 60 to 65% in equities, which is in the stock market, and the rest of it a little bit of cash and bonds and property. So I've taken an active managed fund of which all of the companies out on the market, and I've just labeled them A to G here. Without looking at names, Jim will possibly look at that later on in the presentation. just to see, is there a big difference when you're comparing funds of a similar profile against each other? So what we're looking at here is company A to G, and here's year to date. So this is from the start of January this year up until the end of July. We have a 1 year per annum figure, a 3 year per annum figure, and a 5 year per annum figure. So I'm just going to bring it down to the 5 year per annum figure. So the 5 year per annum figure for company E is an average return of 1.6% per annum, and that is pretty poor, versus one of the better performers, and the better performer here, company G, which is 6.1. So that's a big difference, and really what that equates to is, company G has made the bones about 30.5% of an investment return for its pension clients in this particular fund over 5 years, versus company E, and they've made only 8. So that's a huge difference. It works out at 4.5% per annum of a difference in the long term, just by being with the better performing fund manager and the better performing company. So percentages are fine, but what I want to show you here is what's the practical pounds, shillings, and pence implication of something like that. So I've taken the example of a male age 50, retiring at age 65. He has an existing pension fund valued at about €200,000, and his company is adding 18,000 per annum, 1,500 a month into his pension for the next 5 years. So if we have a 6.1% per annum growth rate that we saw on the previous slide with the better performing fund and fund manager against a 1.6% per annum growth rate, what is the real difference in that over a 15-year stretch? And it is quite big. 6.1% per annum based on that set of criteria results in a pension fund worth about €908,000. 1.6% per annum results in a pension fund of about 556,000. That's a €350,000 difference. It's not putting any extra money into the pension fund. It's not this guy working harder. It's not this guy working smarter. It's just picking the better performing pension fund with which to house your money, because at least there's a track record there to actually go on. So €352,000 is an awful lot of money. If you want to look at it with a different perspective, if somebody wanted a retirement income of 35,000 per annum, well, an extra 350 grand in their pension fund arguably would allow them to retire 10 years earlier. That's a full decade of extra retirement. Now, whether anybody wants a full decade of extra retirement is a different question, but at least to have the ability to take that time if that's what you wanted. And again, I was looking at this myself, and I was thinking, well, how many work days is that? Strip out weekends, holidays, and bank holidays. I think it's about 2,000 work days. So that's 2,000 extra days to do with as you please. Which I think is a serious incentive for anybody to actually look at getting under the hood of something like this. So I'm going to hand back to Jim now just to discuss a few other topics and to build on this. Thank you very much for listening. Over to you, Jim.
Yes, thank you, Michael. So I want to focus in a little bit deeper into this question as to why different pension companies and why different pension fund managers deliver such varying and such different performance. This is something that we have to understand, and we have to research and analyze ourselves so that we can help our own clients to deliver a better performance in their pensions. So what we find is that each of these pension companies have different fund managers managing their different offerings. And of course, these different fund managers carry out their own detailed analysis, detailed research. And from that, they come up with their ideas and their thoughts as to what they think is going to work and what they think is going to perform. So, for example, some pension fund managers, when we talk to them, they say to us, well, we think Europe is set to perform strongly for the next 5 years. A different fund manager from a different company might say, well, we think North America is going to perform strongly in the next 5 years. Another fund manager might say, well, we think it's emerging markets. Another fund manager might say, well, we think it's healthcare. Another fund manager might say, well, we think it's technology stocks. Again, they have very varying different attitudes, and in terms of the bond market, in terms of property market, all of these things. So they're constantly analyzing, coming up with their own judgment calls, sometimes to get it right and sometimes to get it wrong. And of course, when they get it wrong, they sometimes pay a very heavy price for that, because money shifts from them to a better performing pension company or a better performing fund manager. Of course, while they're carrying out all of that analysis and judgment, we are also doing the exact same thing as advisors to our pension clients, because as Michael has said, we're seeking and striving to deliver and help our clients to achieve this minimum of a 5% growth. Well, to do that, we have to monitor all of those pension companies. We have to monitor all of those fund managers. We have to make our own judgment calls. We have to monitor their track record. We have to keep an eye on them, and we have to give our advice accordingly. And of course, if we get it wrong, we get called to task by our own clients, which is quite rightly what should happen. And in many ways, maybe part of the purpose of this webinar is to encourage you to hold your financial advisor to task, or to hold your clients' financial advisors to task. So this slide here is a very busy slide. It's another way of understanding how fund managers go about doing their job. So this particular fund is one specific fund. It's called the Prisma 4 fund. I'm using this as an example. It's a fund that's provided by Zurich. It's an active managed fund, and that word active is important, and you're going to see what it means now in a second. Of course, there's also funds called passive funds, which some of the pension companies provide, which are a completely different animal. They pick a percentage that they're going to allocate to stock market, to bonds, to properties, to cash, and they tend to leave it at those percentages for quite a period of time, whereas this is an active managed fund. So what this fund shows us is that on the left-hand side, starting, each one of these lines represents 1 month. So it starts in February 2015 and runs right the way up to August 2020. And it shows the composition of that Prisma 4 fund for each of those months throughout that period. So this blue part here, the biggest part of it, is the equities component of the Prisma 4 fund. And so we can see here how the equity component has changed and over time. And it really swings from 40% of the value of the fund up to about 60% of the value of the fund. And it switches based on the fund manager's judgments and decisions as to what they believe is going on in the world around them and where the opportunities are and what's likely to happen in the future. So you can see quite big changes in terms of the composition. And over here, we see that they were quite happy to have government bonds. Over here, we see right now, this year, that they really have very little government bonds and are more focused on corporate bonds. Not only that, even this year, here we have, this is March, April, May, March, April, even when coronavirus was hitting, what did this particular company made a judgment call that they were upping their equities exposure, even when markets were going down. They did call that right, because they did bounce back and they did get the benefit of that bounce back. We see over here right now in the last couple of months, what they've been doing is reducing their equity exposure. So these fund managers believe that the stock market is potentially set for a little bit of a hit. And so instead, they've put the money into more defensive assets, in this case, corporate bonds. They're selecting corporate bonds ahead of government bonds because, as Michael said, there are very little returns available from government bonds, and corporate bonds have the chance of delivering a better performance. So as we can see from this slide, they do change their views, their attitudes. This fund is called the Prisma 4 Fund, so it's always had the same name, yet the composition of it changes quite a lot over time. And that's something we have to keep a very close eye on and monitor and know about. So when we are talking about to our clients about pension fund selection, these are some of the things that we have to look at quite deeply. As Michael has looked at age appropriate selection of funds, we do have a lot of contact with the pension companies and with fund managers to explain to us what their approach is. We monitor these people, their performance, we monitor their track record, we monitor their fees, we compare their how they're delivering, and if they are not delivering, we call them to account and we ask them to explain, or maybe move money away from them and advise our clients to move money away from them. If there are changes to their investment teams that potentially can signal a change in approach, change in attitude, we like to know about that for those reasons. So move on there, Michael. Now I want to get into a little bit of more detail here about certain things to be wary of when it comes to pensions. What we find in our research and our ongoing day-to-day work. So pensions with banks, beware, they tend to have very high fees. We find that we have to meet and formally monitor and review the performance of our clients' pension on at least a once-a-year basis. Tended to involve a meeting these days, lots of Zooming going on and etc. So we don't see the banks doing that. They don't tend to have a bank will tend to have one pension offering. They will tend to have very limited fund choice to choose from. So you won't get the range, you won't get the choice really from the banks. And Michael showed us some performance figures from different companies. Certainly one of the poorer performers there was New Ireland, which is part of Bank of Ireland. So just be wary. We have certainly been moving money away from New Ireland in recent times due to poor performance reasons and to help our clients to get better returns. Another thing to be conscious of and wary of is allocation fees. You can see allocation fees of between 1% to 5%. Has a big impact on performance. I have a case study which we'll look at in a second on this. And so again, the banks are quite high with these fees. We believe this should be 0% allocation fees, and certainly that's what we do with our clients. The importance of yearly advice I've mentioned. Similar risk funds, I'm going to look at a case study very quickly on that now in a minute. But beware that all companies have funds that don't perform. Most of these pension companies have at least 50 funds each to offer their pension clients. So there's a lot of choice. So you need to be careful and to be conscious that even some of what might normally be a top performing pension company also has poorly performing funds within its stable. So it's very important to benchmark these funds against each other. Aviva have been performing poorly for the last number of years in some of their older multi-asset funds. We have had to move money away from Aviva for those reasons. And be also aware, of course, they bought out Friends First 12 months ago. They now, from this month, Aviva can access all of those Friends First fund offerings. Be careful. Michael has mentioned the 0.65% fee that Bank of Ireland is applying to self-administered pension fund cash just in their bank accounts, in self-administered bank accounts. So be aware of that. If you have a self-administered pension and it's in cash, probably you don't need to have a self-administered pension in the first place. It's only applicable really if you have property or other assets that you are investing in yourself. So maybe it can be a good reason to move it out of a self-administered structure into one of the normal pension companies. Avoid the 0.65% negative interest rate, and also avoid some of the compliance that goes with self-administered pensions. For example, the need to produce yearly accounts. UK pensions and Brexit, be conscious of it. You can move UK pensions. In the last couple of years, we've been moving a lot of UK pensions over to Ireland quite successfully. It takes a bit of time, there's a bit involved in it. I want to move that, Michael. I want to talk very briefly to show you the impact of an allocation charge. In this example, same example that Michael used, there's a 3% allocation charge, which has cost this person €13,000 in unnecessary fees, can be avoided. And the allocation charge is decided on typically by the broker or by the bank. So typically it's going to them in fees that really and truly can be avoided. You mightn't even see it on a pension statement when you're looking at a pension statement. So it's important to do the background benchmarking to discover what's really going on there. I promised I'd show you this slide, which shows you two very similar risk profile of funds. It shows us what happened in the coronavirus this year in terms of the drop that Michael referred to, the 30% type drop. But yet, even though they have similar levels of risk, they have very different performance over the last 12 months. So one of them has delivered plus 10%, the other one has delivered plus 2%. Another example of the type of monitoring that we have to do to keep ahead and abreast of who we can trust to deliver a performance. And it's not only about delivering in good times, it's certainly also about what happens and how they behave when times become more challenging. The biggest reason why this one, the orange one, performed much more stronger than the red one is because the fund manager in the better one made changes actually during the coronavirus downturn, and they shifted funds into more technology type funds, and they made that call. They got that call right, and as a result, got the benefit in the value of their fund. So, as we were putting together this presentation, we thought, well, perhaps we should at least help you to take a look at your own pension. This is something we're happy to do for your clients as well, to do an overview of how your pension is performing, to compare it and benchmark it against other alternatives that are available, to look at the funds that you're in and compare those and benchmark those, look at the fees and charges, see what comes out of that and recommend any changes that might that we see as appropriate. And if that's of interest to you, you can please just type yes in the question field there on the screen in front of you. Joanne, when she's sending out the notes later today, in fact, she'll send them out in the next hour or so. Joanne will send out the notes to this webinar, and you can also respond to that email and say yes if you wish to wanting to avail of this offer. The CPD cert will be going out tomorrow, and then if you are interested in that offer, we can have a quick chat with you over the phone. We can carry out the work during income tax season and perhaps get back to you in late November, early December with the results. Now, time, of course, we actually don't have time for questions, so we're not going to go there. So thank you very, very much for attending, and we look forward to seeing you again in December. Thank you.
Thank you. Thank you very much.